Hello everybody, Brock VandenBerg, Fund Manager for TaliMar Income Fund I. Today, I'll be providing an update on our loan origination and servicing stats for November, as well as the investor returns for October. Additionally, I'll share some exciting updates about our company and provide insights into the current housing trends. Before we dive in though, a quick reminder, through the end of December, we are offering a complimentary TaliMar Income Fund I Sherpa blanket for any new account that is opened between now and the end of the month, as well as an investment of $100,000 or more. Also, if you haven't already, please subscribe to the TaliMar YouTube channel and give us update a like. We regularly post valuable content and we don't want you to miss out. Now, without further delay, let's get started with this month's investor update. This month, we changed up the format a little on the PowerPoint presentation, updated a little. We're going to change around some of the information we're going to share, but it should provide some very good updates as to the performance of the fund, as well as we're going to talk about some updates about the company, and then also still provide insights into the housing market. So let's go ahead and get started. Presentation overview. We're going to talk announcements, overview of the fund. So I'm going to give a quick overview of the fund for those that maybe not invested or are interested in learning more about the fund. We'll provide those fund updates and stats, a market update, and then respond to any common questions that we are getting. So quick announcements. Number one, returned a net yield of 9.45% in October. So again, the fund is always, the numbers that we're going to get are always going to be a month behind. Usually we go ahead and release the numbers the following month on the between the 15th and the 20th. So we should see the updated numbers for November in mid-December. Bullet point number two, we funded 10 loans in November, totaling a little over 12 million. So this is another month that we funded over 10 million, which is, we're getting pretty consistently over 10 million a month. That is a good, healthy number for the amount of investor capital that we have. Our target for next year, we're probably going to be closer to about 15 million per month that we're funding. We added $3.5 million in new investor capital in October, so we're definitely seeing more and more investor capital being added to the fund. And what's great is you've got a good mix of new investors that are coming into the fund, as well as existing investors who are adding to their investment. Fourth, I'm super excited about is that we're in the process of organizing our first inaugural investor summit. What is the Investor Summit? It's essentially an opportunity to bring all of our investors in to not only meet the team, give updates on the mortgage fund, meet some of the vendors that we're working with, and then we're going to top it off with a big dinner on the end of the evening. Most of you, if not all, should have received kind of a questionnaire about what you would like to see in a investor summit. We appreciate those that have filled out and responded to the questionnaire. If you have not, I'll go ahead and add a link to this presentation where you can fill out the questionnaire as well. But we'd love to see you there. We're excited about it. I think it's a great opportunity for us, especially as we grow as a fund, to bring everybody together to meet the team. Second, we also sent out our Investor Insights magazine last month. Thank you, Adela, for putting that magazine together. The magazine essentially is focused or targeted at people that invest in trust deeds or the mortgage fund. We highlight an investor, we highlight a borrower in the magazine, we add a bunch of educational articles from our vendors. We also post performance metrics on the fund. We highlight a recently completed project. And then we add industry news. So if you have not signed up, if you are an investor in the fund, you are automatically signed up. But if you're not an investor in the fund and you'd like to sign up, you can actually go to our website under Invest. And on that drop-down menu, there's an opportunity, or just select subscribe to Investor Insights magazine, and we'll get this magazine out to you. So it's amazing how this magazine has evolved since we first released our first version of it earlier this year. We do release it on a quarterly basis, and just the size of it has grown. So I'm excited to kind of where the direction of the magazine is going. For those that may not know about the mortgage fund, I wanted to do just a quick highlight of the fund. So what the fund is, it's a private real estate debt fund. And essentially, we specialize in financing real estate investors and operators. Vast majority of the loans that we're funding are going to be residential fix and flip or multifamily fix and flip loans. Essentially, our clients purchase properties, renovate them, and then sell them for a profit. We also do more conventional private money bridge loans. These are loans where clients may need short-term debt to acquire a property or refinance an existing loan. So as an investor, you are invested in this diversified portfolio of short-term loans, all secured in first position and all within California. And vast majority of those loans are in the Southern California marketplace. Currently, we have 107 active loans in the portfolio, totaling $94.3 million in outstanding balance. As I had mentioned, all first position loans. And we have no non-performing loans in the portfolio. So the portfolio is extremely healthy. Year-to-date return of the fund, we are approximately 9.54% year-to-date. Our target return for this year was actually 9%. So we've exceeded that by about 0.5%. And we anticipate being fairly consistent at that number through at least the first half of 2025. Currently, the fund has 311 investors and with a total invested balance of $91.37 million. Our goal is to hit $100 million by the end of the year, and we're well on our way to getting to that goal. The fund is a Reg D 506C fund. What does that mean? Yes, it is a SEC registered fund. You do have to be an accredited investor, so you have to have a net worth of $1 million or greater to invest. We did structure the fund as a REIT, a real estate investment trust. Why did we do that? Well, it provides some considerable tax benefits if you invest in the fund as a REIT. The main tax benefits first is that it does qualify you to receive a 20% tax deduction on the distributions, and there is no cap to that deduction, and that's for non-qualified funds, so think non-retirement funds. Also, if you are outside of the state of California and you're investing, you're not subject to California withholding taxes. So if you're in Nevada, you invest, you're not subject to California withholding tax. That's a huge benefit for those that are in low income or low income tax states. And then we are approved on the Schwab and Fidelity platform. So if you're an existing client of Schwab or Fidelity, you can invest through your existing account. That really helps people with IRA accounts. So now you can invest your IRA funds or retirement funds into the fund through Schwab or Fidelity. All right, let's go jump over to loan origination. So these are going to be numbers for November 2024, so for last month. In November, we funded 10 loans totaling $12 million. As I mentioned earlier in the presentation, we're really targeting funding about 12 to 15 million per month at this point. That's about the amount of money we have to deploy from our existing investor base. So 12 to 15 million is kind of our target bullseye every month of loans. Average interest rate was at 10.63%. This is interesting because obviously we have seen the Fed lower rates. We have seen that 10-year Treasury also kind of spiked right at the election period, and then drop back down. But we've been fairly consistent holding our rates at around 10.6%. I know a lot of people ask, well, Brock, where do you anticipate rates to go? And the answer really is I think it's going to be relatively consistent going at this rate up in through 2025, unless we see a considerable amount of more private debt capital entry in the space. Now, it is competitive out there. The big institutional capital providers, private equity funds, are getting into the marketplace, which has put some downward pressure on rates, but we've been able to stay relatively consistent. Average loan size that we fund is about 1.5 million. That is a little larger than what we've done in the past. The nice thing about the mortgage fund over what we had been doing individual trust deeds is that we can go after larger loans. When you do individual trust deeds, imagine bringing together individual investors on any one loan. It's really hard to get loans funded over 1 million because you do have to bring in a large number of investors. Here in the state of California, you're maxed out at 10. But being that now we pool investor capital, we can chase after these larger loans. Why is that important? Well, there's less competition as you get above or get north of that $1 million mark. So you can really have more ability to structure the loans how you want them to be, or me as a lender to be structured, versus stuff that's sub 1 million. You're still really competing kind of in that individual trust deed investor space, and it's harder to price loans out when you're competing with a larger number of lenders. Average loan to value ratio is at 63.37%, so just below what our target LTV ratio of 65%. And an average loan term was 14 months. Now, I've been a big proponent of kind of keeping our average loan term shorter, kind of 12 months or less. But as the fund grows, it becomes increasingly difficult to constantly be putting new loans out that are shorter term. So we're looking to kind of increase that loan term closer to 18 months, keep a more stable portfolio so you're not having to replace loans as quickly. Let's go to the next slide. All right, so what this slide is the loans funded per month. So I went back to November 2023, and what you're going to find is we're pretty consistent on average funding right in that between that 10 to 12 loans per month. And why is this important? Obviously, you want to make sure that you have the right resources internally to make sure that you can fund these loans efficiently and correctly. So currently, we kind of our organization is set up to really do about 10 to 12 loans per month. But you'll notice that that amount, the number of loans really kind of jumps up and down. And there's no real way, if I could figure out a way of only funding 11 loans per month and have that completely static every single month, it would be wonderful. But that's just how the industry works, is that you may have one month that you do 18 loans, and then you have another month that you may only do 5 loans. So this kind of gives you an idea, this graph kind of gives you an idea of how how much of a differential you're going to be funding in loan count per month. What this graph is balance funded per month. So this is loan balance. So you'll notice that largest month in the last 12 months, we just did shy of 20 million. And then 1 month, you're at around 3.5 to 4 million. So kind of same thing with loan count, is the amount in dollar amount that you're funding every single month can be significantly different between each month. And that's why it's vital when you're trying to understand how much investor capital you have to deploy, that you're trying to match up with that investor capital that you're looking to deploy with the amount of loans that are coming in. Again, this is the average interest rate for each month. As you'll notice that we've actually been able to increase the average rate per month just slightly. So we were right above 10.5% in November 2023. And now we're just on average a little above 10.6%. Not a huge differential, but it does demonstrate that we are able to hold rates, which at the end of the day will create a more consistent return to you, the investor. Always like to highlight a recent closing. This was a fix and flip loan of a single family home that we funded up in Torrance, California. Loan term was 12 months. Loan to value ratio, so this is LTV ratio after repair value. We were at 72.76%. Rate was 10.5%. Our borrower is intending to acquire this property. Oh, they've acquired the property. They'll do a moderate renovation on the property and then list it for sale. Great client of ours. We've done 10 projects with this client. So one of the nice things about the private debt space is that typically when you get a borrower, they're going to consistently come back to you for future loans. So it really helps to create a more efficient lending platform if you've already underwritten the borrower and you're only having to underwrite the property itself. Where it gets more complex or there's more of a heavy lift is when you're underwriting both the borrower and the property at the same time. So really, the goal here, or the strategy when you're in the private debt space, is you're trying to stay consistent with the same borrowers. All right, let's talk loan servicing. So these numbers are going to be for, again, last month, November 2024. Portfolio consists of 107 loans with an outstanding balance of 94.33 million. Average interest rate of the portfolio was at 10.58%. Distributed 870,000 in interest income. So the fund earned received 870,000 in interest income. That's, again, an all-time high for the fund. Received 9.53 million in payoffs. Now, the reason I want to highlight this is a lot of people ask, well, Brock, how do I get my or how do I take a redemption from the fund? And really the way that the fund does redemptions is it's going to wait for payoffs to occur in a given month. And then from the payoffs that we receive, we'll go ahead and process those withdrawals. Now, 9.53 is on the larger side. Typically, we are receiving around 4 to 5 million in payoffs every month. But as that fund grows, or as the size of our fund grows, obviously that dollar amount will grow as well. Also wanted to highlight that we have 0 non-performing loans in the portfolio. So non-performing loans are going to be late payments that are 60 days or plus or greater, or if there's actually a maturity default, so the loan runs beyond the actual maturity date. All right, so on to the next slide. What this slide shows is the number of active loans per month. Beginning 2023, we had about 77 loans in the portfolio. We've been able to grow that portfolio up to about 107 loans. So a good steady increase in the size of the portfolio. I like this. It allows us to manage the expectations from our operation standpoint. And so this growth has been a very managed growth. So what this graph shows the outstanding balance per month. So again, back to November 2023, we had just above 60 million in the portfolio in terms of outstanding balance. And now we've grown that portfolio up to a little above 90 million or 94 million. So increased the portfolio by over 50%. But again, a good manageable number. One of the as you grow as a debt fund, you want to obviously ensure that you've got the resources internally to manage the portfolio. And just based upon the stats of the health of the loan portfolio, I feel like we've done a very good job of ensuring that we've got the appropriate resources in place to manage this growth. So we anticipate this kind of level of growth going through 2025, probably adding 3 to 4 million in new debt each month of the portfolio. What this graph shows is the interest income received per month. So what you'll notice here is, again, a good steady growth of interest income. We started November 2023 earning approximately 430,000 a month in interest income. And now we've surpassed 800 million, actually getting pretty close to that 900 million mark. So good, again, good steady growth on the interest income that the fund has earned over the last 12 months. Principal reduction per month. Now, this is not steady, if you'll notice. And this is one of the biggest difficulties in managing a mortgage fund, is trying to anticipate payoffs and then matching the proceeds from the payoffs with new loans that we're funding, as well as any investor redemptions, and then obviously with new investor capital. So it's all over the place. So you may have as low as sub 2 million in terms of payoffs, or you may have north of 11 million in payoffs. And that's why that credit line that we have, that line of credit that we have with our bank, is so important, because it's really hard to manage the inflow and outflow of capital. So again, the inflow of capital is new investor capital and payoffs. Outflow of capital occurs from new loans that we're funding, and then any investor withdrawals, and then also construction funds that we have to disperse for our construction loans. So it's all over the place. This is, if you ask me what one of the hardest part of the jobs is managing cash flow expectations. What this table shows is loan balance by county as a percentage of loan portfolio. So a lot of people ask, well, Brock, where is the high concentration of your portfolio? It's always been in San Diego. Obviously, when we established the company in 2008, we've really built up our client base here in the San Diego market, which is why we're so one-sided in the San Diego market. But we are looking to expand. We're looking to get more exposure into the Orange County and LA market, and we'll slowly do that. It just takes time to get into the marketplace, figure out who the players are in there, and then be a resource to them for their borrowing needs. But again, by far, San Diego still remains our biggest percentage of our loans. What this table here shows is property type as a percentage of active portfolio. Again, SFRs have kind of been our bread and butter. SFRs, in terms of a property type, are going to be the cleanest property type that we're going to be lending on, and actually is the least lowest risk, just because obviously SFR, single family homes, are the most transacted property type. Second is going to be your multifamily. So when you combine the two of those, you're really about 90% of the portfolio is at some type of residential component to it. And then the rest here shows the remaining property types. So mixed use, industrial, retail. And then you get sub 1% for assisted living, land, and manufactured home. I will say that we're starting to see more multifamily type loans as we grow, especially here in San Diego. Multifamily properties trade at a higher loan balance. So as the fund grows, we can be a resource on those larger loans to these types of investors that buy the multifamily property type. And then also you're starting to see a little more mixed use properties. So you're seeing a lot of kind of Class C retail being repositioned. We're seeing some of that coming through our loan origination pipeline as well. Loan type as percentage of active portfolio. So this essentially, we offer 3 primary loan types. That's going to be your fix and flip loan, your bridge loan, and then your new construction loan. Fix and flip loans, borrowers acquiring a single family or multifamily property. Usually there's a renovation reserve component, so we're going to disperse construction funds to the client over the course of that project. Again, it's been our bread and butter since 2008. Makes up about a little over 46% of the portfolio. Second is your bridge loan at 31%. Now, the big difference between a bridge loan and a fix and flip loan is a bridge loan is there's usually no construction component to it. It's based upon current value. Client needs a short-term financing to either close on a property or maybe they need to refinance an existing hard money loan. And then you've got new construction. Now, some will notice that's a pretty big jump on new construction loans. And the reason being is that we're doing a lot more ADU projects. So this is where a client is buying a single family home. They may be renovating that house, but then they're adding 3 to 10 units in the backyard. I know for those that are outside of the California, that sounds crazy, but it is a very popular type of investment now, especially with the city of San Diego, and a lot of California urban building or markets are really pushing new housing through ADUs, accessory dwelling units, and building additional units on that property. So we're seeing a lot more of these types of deals and have had really a good experience and good outcome of targeting these property types. In fact, I'm excited to highlight a project that we had funded. They're building 6 units in the backyard of a single family home. It should be done here in the next, I'd say 3 to 4 months, and I'll do a quick video highlight of how the project got brought to us, how we structured the loan, and then the result of the project. I'm excited about that one. Okay, here's a recent payoff. So this is an example of a fix and flip. Once it's done, our client acquired the property. It was a single family home here in San Diego. It took him 4 months from what we call key to key. So from the time that he purchased the property to when they sold the property, and did a full renovation of the exterior and interior. So this is kind of a good idea of what these properties look like after the renovation is complete. The duration was 4 months. So obviously these are shorter term loans, which is why a lot of our loan portfolio looks fairly short term because we focus on this. But it was a successful transaction for both the borrower and us as well. Final loan to value ratio on this project was at about 54%, interest rate at 10.5%, and it was the sale of the property. So still a very popular loan type that we're funding here in the Southern California market. All right, let's move on to investor relations. You'll notice that we're going to talk about the October numbers. So I mentioned earlier, it takes us about 15 to 20 days after the close of the prior month to post the investor return figures. So in this case, we're going to go ahead and just talk about the October 2024 figures. So in the portfolio, we have 311 investors totaling a little over 91 million. The fund did grow by 3.35 million, as I mentioned earlier. What's great about this number is that we're pretty consistent of raising between 3 to 4 million per month. That consistency actually allows me to better plan for the amount of loans that we're going to originate in any subsequent months. We earned a 9.45% annualized yield in October and brought our annualized year-to-date return to investors for 2024 at 9.53%. What I'm excited about in terms of 9.53% is we did go into 2024 kind of targeting that 9% yield, but we blew that away by over 0.5%. And I feel that we're going to stay relatively consistent at that number through the early portion of 2025. We distributed over 714,000 to investors in October. Again, a high that is the high for the fund historically. So, congrats to all the investors. I'm excited about the future of the fund and its growth. All right, let's get into our graphs. So what this graph is the number of investors per month. So these are the number of investors that are in the mortgage fund. Again, we've had very steady, consistent growth with the number of investors in the fund. And like loan servicing, where you're servicing loans, you're servicing, from this perspective, you're servicing investors. And you want to make sure that you have the appropriate resources internally to manage the number of investors that you have in the fund. So many of you have worked with Susan Jones in our investor relations department. She's doing great. And she's been a great point of contact in helping us manage the number of new investors coming into the fund. Just a quick reminder, as I mentioned earlier as well, that if you are interested in opening a new account, we do have a promotion going for the TaliMar Income Fund Sherpa blanket. So if you open a new account and invest 100,000 or more, you will receive a TaliMar Income Fund Sherpa blanket. And it is soft and it is great for any home decor. And if you do get one, I want to see a photo with you with the blanket. Total investor capital by month. So what this table shows is investor dollar amounts per month. And again, pretty consistent. One of the themes that I think I want to really kind of highlight is the consistency of the growth of the fund. So November 2023, we had slightly above 60 million in total in terms of total investor capital. And by the end of October, we had a little over 91 million. We should be at the end of November about 95, and then with the idea of getting to about 90, almost 100 million by end of December, which is our goal. All right, we're going to jump into the market portion of the presentation. I want to start off with market predictions because I get a lot of people asking, what do you anticipate in the market in 2025? Well, I feel that the housing market will remain relatively consistent in 2025 in most markets. Now, we did see a noticeable pullback in some markets across the country, especially those markets that were able to take advantage of people moving from markets like California, New York, and other areas that have been able to take advantage of that population that have been leaving and moving into the new markets. So you've seen some markets of Florida, you've seen some slowdown in some markets of Texas, some markets in Arizona have seen a slowdown. But if you were to just generally say in the state of California, most markets have remained relatively healthy, especially San Diego, which actually took advantage of people leaving Los Angeles and the Bay Area, moving to the San Diego market in 2024. So what do I predict in 2025? I think home prices will rise at a clip of about 4% in 2025, essentially inflation. And that's what you've kind of, if you looked over a long period of time, that's kind of what appreciation you see in most markets generally. Mortgage rates will remain near 7%. Yeah, I think that rates are going to be in the mid sixes for most borrowers, and that's a healthy number. I think that's a number that is more consistent, generally what we've seen historically than what we've seen where rates were in the 2 to 3% range. And I don't think that's going to impact home values all that much. Number of homes listed for sale will increase by 10%. I think that we've seen historically a very low number of homes listed nationally. And so I think the only thing that it will do is go up. And I think you're going to see a decent increase of about 10%. I think you're going to still see people that don't want to sell their home because they've got mortgage, an interest rate that is very low, so there's no reason to move. But I also think there's more pressure on people that want to just stay in their house longer. They don't want to sell it. They don't want to deal with the tax consequences of selling the property, so they're just going to hold on to that property. I think rents will remain flat in 2025. We did see some downward pressure on rents in 2024. And when you couple that with rates rising in 2024, I think you've had some issues in the apartment sector, but I think generally you're going to see rents still remain flat in 2025. AI will result in a consolidation of the industry. AI is coming at us extremely quickly. We see it in the lending industry and how much more efficient we can do our lending with AI. I think that's going to impact the residential housing market, and I know it's going to be for the good. I just don't know how it's going to impact it. So we'll see how that happens in 2025. But I do see some of the larger companies consolidating and merging. Urban centers will adopt pro-growth strategies. I think areas like San Diego, I think San Diego has already taken a pretty aggressive approach, but even LA and the Bay Area will take an aggressive approach of cleaning up urban centers. They have to. The current things that they're doing in kind of the direction these urban centers have gone are just pushing people out of those markets. So we'll see what happens in these core urban markets of California. All right, let's talk about the housing market nationally. These are all numbers that I did pull from Redfin. You can all do your own search on Redfin, and this is all public information. So let's start off. Median home sales price in October of 2024 has a 5% increase from October 2023 to an average sales price of $434,000. Number of homes sold was up 6% at 428,000 home sales, and the number of homes for sale increased considerably, actually increased 15%. These are all healthy numbers. Now, one will say, okay, well, Brock, number of homes sold or for sale increased by 15%. That's a pretty big jump. But yes, we were almost near zero, though, homes for sale. So anything coming to the market is probably good for the market. So we're at 1.8 million homes currently listed on the market. Days on market, 41 days. I like to see days on market at or below 45 days. So we're getting pretty close to that 45-day mark. So we're definitely keeping our eye on that. Months of supply, 3 months. That's a very good month's supply of housing. And the average fixed rate mortgage in October of 2024 was at 6.4%. We've actually seen a slight decrease in that fixed rate interest rate. People always ask me, where are people moving from and where are they going to? So top 10 areas people are moving to nationally. Number one was surprising, was Sacramento. And then you've got Myrtle Beach, South Carolina, Maryland. And then where are they moving from? Well, I don't think it's the top three are any surprise: Los Angeles, New York, and San Francisco. Seattle's kind of a surprise. Washington, D.C. is not, just the high cost of housing, probably with Washington, D.C., Chicago. Obviously, these are all markets that are dealing with also urban flight. urban deterioration. And I think these are all markets that are really focused on improving their downtowns and core markets. All right, let's talk California housing market. So median home sales price was up 5.1%, actually pretty consistent with what happened nationally to 839,000. A lot of you say, I thought, it was $1 million. This includes single family and attached housing. Number of homes sold was up 13.3%, 20 to 24,000 units sold in October of 2024. Now, again, it's hard to read into this because there really have been no homes available to purchase in California. So now that we're starting to see more and more homes coming to the marketplace, that you're going to see this number increase. Same reason here. What you see is number of homes for sale. That's increased by 25%. Again, tough to really read into that because there were near zero homes for sale this time last year. So any increase in that number is going to be seen as a considerable increase as a percentage of number of homes sold. So I wouldn't look too far into it. Days on market still very healthy at 36 days. Months of supply at 3 months. So California housing market generally is remaining robust and is healthy. So top 10 metro areas in California with the fastest growing sales price. Laguna Niguel, congratulations to all the investors that are in Laguna Niguel. You saw this fastest growing sales price on your house there. Encinitas down here in San Diego, a little coastal town. Mountain View up in the Bay Area, Chino Hills, Redlands. So these are all the markets that have seen a considerable increase in value sales price. All right, let's take a look at the San Diego housing market. One of the shining lights in terms of markets nationally over the last couple of years. So from this time last year, the home values have increased by 3.8% here in San Diego to median sales price of $950,000. This includes attached and detached homes. Number of homes sold, 858 homes. Now imagine this, you had 858 homes sold in October for a population of 1.3 million. So you're literally selling no homes for that size of a population. Yes, it says 25% increase, but you're literally no homes are available. So up 24.8% in terms of homes for sale. So again, you have 2,700 or 2,800 homes for sale for 1.3 million people in San Diego. Very little inventory. Days on market at 27. We did see a little jump in the days on market. I think some people have some unrealistic expectations of home values, which is forcing homes to resulting in homes being on the market a little longer. But you still only have a 3-month supply. So San Diego housing market remains very, very strong. And I would say anecdotally from the loans that we're doing, so once a borrower completes a renovation on a property and it's been listed, I'll tell you that we are getting payoff demands for that loan within 2 to 3 weeks. So they are moving properties, especially homes that have been recently renovated or in good condition, are moving very quickly. All right, let's talk about where are people moving from when they come to San Diego and where are people leaving to when they leave San Diego. So let's talk where they're coming from. Los Angeles, that this isn't a surprise. People coming from LA to San Francisco, maybe looking for, well, I'd say it's crazier, but maybe a cheaper cost of living, and also for the sunshine. So other places people are coming in from, Washington, D.C., Dallas, Texas. Surprised there. I thought everybody was moving to Texas, but they're coming from Texas. I think they're trying to escape all the heat. New York, Seattle. These are all the areas that people are moving to San Diego. Where are they leaving for, though? So Portland, Oregon tops the list, which I thought was interesting because you're leaving the sunshine to the rain. Las Vegas, Nevada. Yeah, these aren't surprised. Actually, we lost some good friends to Nashville, Tennessee, Arizona. And I think people are just looking for lower tax states to move to. So that's where people are going. All right, let's talk about the Investor Summit. So again, right now we are looking to schedule the Investor Summit for late March. And the intention is to bring all of our investors in town to meet everybody in person, to talk about the mortgage fund industry, to talk about the real estate industry and the growth opportunity in the private debt space. The idea is to have various panels so our guests can listen to the various vendors and people in the industry to listen to their thoughts and ask questions. And then give an opportunity for you to meet our team because as we grow, we've now surpassed 300 plus investors. We don't have that one-on-one relationship that we've had in the past when we were doing individual trust deeds. So we wanted to make sure that we gave you the opportunity to come in and meet the team, and then we could sit down with you as well and answer any questions. Right now, we're looking at the La Costa Omni Resort to have the event. And we did send out that questionnaire for people that are interested or gathering information if we want to have it on a weekday or a weekend. What we're seeing already right now, though, is it's about a 50-50 split of either having it on a weekday or weekend. So we'll let you know more specifics as they come in. And then we'll also have a web page for you to go to learn more about the Investor Summit. Just a quick reminder, our Sherpa blanket promotion. Just look how beautiful that this blanket looks in this room. Actually, this is one of our team members had the blanket out. We're going into winter. It's a great blanket to have when it's cold out there. You can receive one of these blankets if you open a new account and invest $100,000. We're running this promotion through December 31st, so be sure to reach out to our investor relations team and open up that new account. You can also go on our website at TaliMarFinancial.com, select Invest, and under the Invest tab, there is Open New Account, and you can go ahead and open a new account that way. Once you've opened a new account, you've invested, we're going to send you out this beautiful investor TaliMar Income Fund I logo blanket. So excited about this one. All right, just a quick overview of the investment process. I know a lot of people have questions about how you can get started. We made it very easy. First step in the process is to submit a new investor account form. Once we receive your new investor account form, we're going to have you complete the accreditation requirements. So again, you have to have a net worth of $1 million or greater, and you can show that a number of ways. Most people get a letter from their CPA stating that they have a net worth of $1 million or greater, but you can also submit a balance sheet, and with a quick credit check, we'll go ahead and accredit you. Or you can meet those income requirements. And the income requirements is $250,000 each year for the last 2 years if you're single, and $300,000 if you are married. And then once you've completed the accreditation, you go ahead and sign the subscription agreement via DocuSign, and then submit your funds, and away you go. If you have any questions about the investment process, feel free to reach out to my investor relations team. With that, I'm going to finish up our December 2024 investor update. If you've got any questions about anything that I talked about, feel free to reach out to me. You can either call me here at 858-242-4900 or send an email to invest@TalimarFinancial.com, and my team will get back to you with any questions that you have. But remember, just a quick reminder, the promotion that we're going on is these investor blankets. They're beautiful, they're cozy, they're going to keep you warm, and we'd love to see a photo of you in the blanket or underneath the blanket or with the blanket. And one last thing, quick reminder, if you like this video, give it a like, and definitely subscribe to the TaliMar Financial YouTube channel to get all the updated content that we post. And with that, thank you for listening.